Now, creating options for institutional investors. That's what led my next guest to start the electronic trading exchange Pipeline Trading Systems. Fred Federspiel is the chief executive of Pipeline, and he joins us now. Fred, good to have you with us on Bloomberg.
It's wonderful to be here. Thank you for having me.
Now, for those that don't understand what Pipeline actually does, where do you sit in the world of investments? Because institutional investors are coming to you to help them solve some problems. What are the issues?
They certainly are. You know, institutional traders come to us for our unique perspective, looking at the interaction between the high-frequency trading that's come to dominate the markets and the institutional investment community. And what we work on is helping them extract the liquidity they need out of the markets without paying too much for it. As the high-frequency trading has come to dominate the markets, there's quite a spread in costs for extracting liquidity. We help our customers stay on the low end of that curve.
All right, so maybe give us an example, because if you're a big institutional investor and you want to sell a large number of shares in a particular company, you don't necessarily want to telegraph that to, as you describe it, 70% of the market, which are now high-frequency traders.
Right. The stock would completely get hammered. And so what you need to do in that case, if you're selling a large number of shares, millions of shares, what you need to do is feed those shares into the market in a controlled way. If you simply let the market dictate the way those shares would execute, you would sell many more shares at low prices than at high prices. And what we do is use predictive analytics, same tools that the high-frequency traders do, to invert that. And we help our customers sell more shares at high prices and fewer at the low prices.
And would this be the result of sort of when you place the trade? I mean, would someone come to you and say, all right, let's say I want to sell 1 billion shares of something.
Right.
You could tell them, based on your algorithmic special sauce, that if you place a certain number of shares on the, for a bid at 11 a.m. in the morning, you're going to probably get this, and watch the patterns so that you'll be able to sort of get that average fair price.
So that's certainly a component of it. But what's interesting is with the rise of high-frequency trading techniques, the players who are trading against you have tools that are making predictions on the few-second time scale. So it's not sufficient to lay out a schedule that says at 11 o'clock do this, at 11:30 do that. You have to monitor the market literally second by second. And so what we're doing is helping traders feed shares into the market minute by minute and really control that rate when they need to control it, and be opportunistic and accept fills when it's good prices for those traders.
So do you then fit into the existing systems that the big institutional traders already have? I mean, do you plug Pipeline into their trading platforms?
We certainly can plug into customers' platforms, and we provide for customers who'd like a complete solution. So we can span the range from a plug-in module on trading advice up through a complete platform.
Now, when you mentioned the idea that 70% of the daily volume is now controlled by high-frequency traders, what has been the response from the institutional community? Are they trying to figure out a way to use that to their advantage, or they just wish that it could go away, but they know it won't?
Well, now that we've got 70% of the liquidity coming from this high-frequency strategies, job one is realize how critically important it is to have liquidity in the U.S. markets. So they provide tremendous liquidity. It's a great thing, but it has to be dealt with carefully. And institutions, the main job that they need,
because it's selective liquidity, right? I mean, they're not under any legal obligation to make a market in a stock. They can pull the liquidity back when it's not in their best interest.
As we saw on May 6th, for example, they can be very quick to pull back, and resulting in a flash crash. So it's very selective liquidity, and you need to use the same types of tools where they're trying to predict when the stock is going to go down, and they'll sell into that. You need to predict when the stock is going to go down, and be very careful about how much you sell at that time.
What kinds of institutional investors are using Pipeline right now?
So it's the largest institutional traders, the mutual funds, the asset managers, pension funds, hedge funds, so large asset managers.
And is it a necessarily huge infrastructure at Pipeline to make this happen, or can you do this with a few number of people?
No, it's a significant infrastructure. We've got a tremendous investment in real-time predictive analytics, data feeds, processing all kinds of market data, all kinds of news. So it is a significant investment, but it pays off in terms of reducing costs for our users. What we see is almost half of their trading costs typically are coming from the interaction with high-frequency traders, and we've been able to eliminate most of those costs through the techniques that we've developed.
All right, I want to thank you very much. Fred Federspiel coming to us as the Chief Executive of Pipeline, shedding a little bit of light into a institutional investor situation dealing with high-frequency trading. Thank you very much.